Now, today we are focusing on the Investor Summit, and the next topic that we've got in store for you, it is combine digital asset custody and trading to achieve best price execution. To share with us more, we have Andy Flury, founder and CEO, AlgoTrader, Switzerland.
A few years from now, every type of asset will be tokenized, be it company shares, real estate, or even art. This will disrupt how banks operate, and it will require a new generation of financial technology components that don't yet exist today. Eventually, holding and transferring value will be much more integrated into our daily lives than they are today. In the future, we will be able to purchase a fraction of a tokenized building, for example, exercise stock voting rights through smart contracts, and transfer ownership of literally everything through smartphone and social media accounts. My name is Andy Flury. I'm founder and CEO at AlgoTrader. Let me tell you a little bit about us. AlgoTrader is a Swiss-based fintech software provider. Our product is the leading order and execution management system for both traditional and digital assets. We provide a unified API connection to the largest and most regulated crypto trading venues out there. We started in 2014 and have since then signed on over 100 clients globally. We are a team of 30 people with offices in Zurich, New York, and Singapore. And as a fintech startup, we're backed by investors like FinLab, Credit Suisse, Blockchain Valley Ventures, Investire, and Neue Capital. But enough about us for the moment. Today, I'll take you on a deep dive to examine how to combine digital asset custody and trading to achieve best price execution. Here is what we're going to cover today. First, we're going to talk about best execution and what that means for digital assets. Then we'll talk about the different components a financial institution needs to offer crypto custody and trading to their clients. And finally, we'll talk about exchange pre-funding, why that is a problem and how to overcome it. But let's start with the business case first. There are some very good reasons why banks and financial institutions should consider embracing crypto and digital assets in their offering. First, you can expand your client base and services with a new, highly uncorrelated asset class. This new offering will provide a new source of revenue independent of classic capital markets. Also, starting with cryptocurrency offering is a very good exercise for preparing yourself and your company to then scale up to the security tokens later on once those become available on secondary markets. Many people, especially the younger generation, already hold cryptos. Let's be honest, banks have always been specialized in safekeeping assets for clients. It's therefore very natural for a bank to also offer custody for clients already holding crypto assets. And finally, offering digital assets also allows the bank to polish up its image and foster their perception as an innovative bank. It seems like an easy win, right? Well, yes and no. Let's face it. Trading digital assets is not as simple as it might seem, especially for financial institutions. Throughout the following slide, we'll be discussing a few of those challenges in more detail and how to overcome them. The first challenge is that financial institutions, and especially banks, must provide best execution for their clients, which means that the bank has to guarantee that the clients are getting the best possible price when buying an asset. Especially when it comes to digital assets, providing best execution is actually not that simple. That's because the liquidity of an individual exchange is typically very thin. Today, only about 30% of all crypto trades are executed on crypto exchanges. The remainder is executed through market makers, OTC desks, dark pools, and decentralized exchanges. So yes, it is a bit like an iceberg, as you only see a fraction of the whole, and we all know what can happen then. The second major problem is that crypto liquidity is notoriously fragmented. Today, there are over 350 crypto exchanges, and the crypto landscape can be viewed as a network of liquidity sources and liquidity consumers. And unfortunately, many players do not disclose their sources of liquidity. So to achieve best prices, a bank needs to tap into this network at multiple places and compare prices before sending an order. We recommend that banks should connect to at least 3 to 5 venues simultaneously. But this is not too trivial either. In a resource-constrained world, a bank would need to build, operate, and maintain connectivity to many different liquidity venues and implement and maintain an execution management system to ensure best price executions. To make matters worse, there are no common standards in the crypto space for building and maintaining these connections. So trying to connect to the crypto trading venues is a bit like arriving at a hotel, trying to plug in your phone to charge it after a trip, only to realize that it doesn't fit into the socket and you forgot to bring your adapter. So the digital asset landscape is a little bit like a hotel room where every socket has a different shape and none of them use the same voltage. So this lack of common standards makes digital asset connectivity such a complex challenge. And this is exactly where AlgoTrader comes into play. We provide financial institutions with a single fixed API connection to the most liquid and regulated trading venues out there. And by the way, FIX, as most of you know, is a protocol that financial institutions are very familiar with and have used for decades. So now we have connectivity covered, but that's not it yet. Especially for large orders, we need so-called execution algos to split up these orders into smaller child orders and then place them in the market in a randomized fashion to minimize slippage and front running. And last but not least, we need a smart order router to automatically select the venue that currently has the best price and liquidity for each trade. What you see here is the order book for Bitcoin USD with prices from various exchanges. Let's look at the example in more detail and see how this works in practice. On the left side of the table, you can see current bid prices in decreasing order. So these are the prices you would receive when selling Bitcoin. And on the right side, you see current ask prices in ascending order. So these are the prices you have to pay when buying Bitcoin. The top row is called top of book. So when buying up to 2.5 Bitcoin, you would pay $19,156 on the Gemini exchange. But what price would you have to pay if you wanted to instantly buy, let's say, 12 Bitcoin? In that case, you would have to split up the order over multiple exchanges. And in our example, we would be buying 2.5 Bitcoin on Gemini at 19,156. We would be buying 2.75 Bitcoin on Kraken at 19,159.73. And then another 3 Bitcoin on Kraken again at 19,166.28. And finally, the remaining 3.75 Bitcoin on Poloniex at 19,167.24. Okay, so the average price we would have to pay for this order for the 12 Bitcoin would be 19,162.93, which is, by the way, less than you would have to pay if you were to trade a single exchange only. Sounds complicated, right? You'll be glad to hear that you don't actually have to do this yourself. The smart order router will do it all for you. So now we have all pieces in place. We are combining connectivity, execution algos, and the smart order router to overcome liquidity fragmentation and get true best execution. But there is one more thing to add when we talk about best execution. So in addition to execution algorithms and smart order routing, there is also the so-called OTC or over-the-counter trading. This typically happens through request for quote or RFQ process. Using RFQ means asking venues to provide a binding quote to buy or sell a certain quantity of an asset. With AlgoTrader, this process is fully automated. The system even allows you to automatically send RFQs to multiple venues and automatically select the best quote received. So the main difference is that with RFQ, you already know how much you're going to pay before committing to the trade. However, this certainty you get with RFQ is not free, as market makers price their risk into the spread. With best execution, on the other hand, you might be facing price moves while your order executes. This might play in your favor, but just as likely it can go against you. Our recommendation is to go with RFQ if you are in a hurry, and otherwise use execution algos as they are cheaper in the long run. So let me show you how easy AlgoTrader is to use and what you get. So this is what AlgoTrader looks like. Our UI shows all the relevant information professional traders need. This includes configurable charting, full order book, open orders, order placement, market data, open positions, cash balances, latest transactions, multiple portfolios, portfolio metric, advanced orders and smart order routing, as well as RFQ order. Now let's dive a little bit deeper and look at the actual components a bank needs in order to offer crypto custody and trading to their clients. So in addition to the core banking system they already have, they need an institutional-grade crypto storage solution to safeguard their private keys. Amongst others, this is actually what our partner company Medico provides. Then the bank will need a solution to transfer and manage liquidity. Solutions like Fireblocks come in very handy for this part. And then finally, banks need a solution for trading and execution of digital and crypto assets, as well as the actual connectivity to the trading venues. Our product AlgoTrader is the perfect solution for this part. Now, another big issue financial institutions face when starting to trade digital assets is that literally every crypto exchange requires you to deposit funds on the exchange's hot wallet before you can start the trade. Now, why is this problematic? First, this pre-funding requirement presents a huge counterparty risk. It can be a bit like entrusting Count Dracula to guard a blood bank. Since 2012, some $11 billion have been stolen from exchanges. Many exchanges remain largely unregulated and only a few have proper licensing in place. And as a rule of thumb, if you do not own your private keys, then you are not in control of your funds. Secondly, managing your balance sheet over multiple venues is challenging. Keeping track of all your wallets is a tedious exercise. On the other hand, transferring your assets between venues is very slow, especially for the fiat side when sending funds through SWIFT. But even Bitcoin transfers take anywhere from 10 minutes to an hour or more, depending on network congestion. And last but not least, trading crypto derivatives requires you to deposit margins on your exchange account, and unfortunately, cross-margining is not yet possible, so literally you have to deposit collateral on each exchange you trade. So, as we've seen, trading crypto exchanges can be problematic, but what are the alternatives? So the first alternative you have is to work with a broker. Brokers provide trading based on credit lines, so no pre-funding is required. Most brokers provide both agency and principal trading. Their fees are quite a bit more expensive than exchanges, typically 0.5% to 2%. Some brokers provide APIs as well, but they are generally less mature and not frequently used. The other alternative is to work with a market maker or an OTC desk. They also don't require pre-funding and also provide credit lines. They do this by supporting post-trade settlement on a DVP, which means delivery versus payment basis. Market makers typically don't charge fees, but instead include their cost into the spread, typically around 0.1% per order. Most market makers do, however, require a certain minimum monthly transaction volume that can range anywhere from $1 million to $10 million. Then, last but not least, there is DeFi. How could I be talking about crypto trading and not touch DeFi, right? Specifically, what we're talking about here is DeFi liquidity pools or decentralized exchanges. Today, over $14 billion are locked in DeFi. With liquidity pools, there is no order book and no centralized party. Instead, trades are executed against smart contracts through token reserves. One limitation is that liquidity pools are only available for Ether and ERC20 tokens, but not for other non-Ethereum based cryptocurrencies or fiat. So these are the options you have today. But there is also something else on the horizon that will revolutionize crypto trading. Custody providers like Fireblocks and Copper are working on a so-called off-exchange settlement, where your funds stay in secure wallet within a highly secure custody solution. Transfers happen instantly within the custody network with 0 blockchain confirmations. And through connections with banks like Silvergate and Signature, even US dollar transfers are instant. This all came about because exchanges and custodians have recognized the problem of pre-funding and decided to come together and find a solution. This brings a huge advantage to active traders, as you can now instantly transfer your assets just before placing a trade, which brings a huge increase in capital efficiency. To give you an idea on how this looks in practice, here is the AlgoTrader screen that shows you all your assets broken down by venue, custodian, account, and asset. With this single screen, you have the complete overview of what assets you own and where they are located. So, ladies and gentlemen, this brings me to the end of my presentation today. I hope you enjoyed it as much as I did. Thank you very much.